Hi guys, welcome. I was studying Marvel's financial reports and was expecting bumper profits just like all the rest of the players in this space. Marvel produces chipsets in the 5G space, but it is the odd one out that is losing money when all the other players in this space are riding on a wave of demand and hitting record revenues. I wanted to find out what is going on here and will share some of the interesting insights in this video. So let's jump into it. The revenue has been on a steady rise since Q2 of 2017 from $579 million all the way to $797 million in the most recent quarter. However, the operating income has gone into a negative since Q3 of 2018. I found this very interesting that all of a sudden a profitable company goes into the red. There must be a reason. The first thing I did was to look at the operating expenses. Indeed, there is a rapid increase in R&D from 176 million in Q2 of 2018 to 264 million in Q4 of 2018, an increase of 50%. And it has stayed at this level ever since then. Something must have happened here, either change of direction, the introduction of a new product, or increased cost of an important component. So I did some research and found out that Marvell bought a semiconductor chip maker called Cavium during this time. The article goes on to mention that with the acquisition, the combined company is expected to generate $3.4 billion in revenue. Now let's go back to the revenue chart to see if this has panned out as planned. Based on the quarterly report, even if we take the most recent revenue of 797 million, which is the highest in recent times, it will come close to 3.2 billion annual revenue. So the expected combined revenue of 3.4 billion has not materialized. And before the acquisition, Marvell was already raking in annual revenue of 2.6 billion. So instead of a big jump, the revenue has only seen a marginal annual growth of 528 million. But Marvell seems committed to this project and has not reduced any R&D investment. Their strategy seems to be to incur short-term losses for a promise of a much bigger gain in the future. So next, I wanted to find out whether all that R&D investment is moving towards higher operating income or are the losses widening. Marvell's revenue has been on a steady growth trajectory as you have seen in the earlier charts, and the losses have reduced drastically in the most recent quarters. Seems like they are moving in the right direction indeed. Marvell made a small net income of $16 million after a string of 8 consecutive quarters of losses since 2018. The exception being this one-time big gain due to a tax benefit of $1.7 billion. Has Marvell finally turned the corner? If they have, it could be a fantastic turnaround play. That is why I find Marvell very interesting. As they have been running losses, the net margin parameter is of little use. The useful part though, as they have been running losses, the net margin parameter is of little use. The useful part though is the margins they have been enjoying in 2017. They have been running net margins of 18 to 32% with their other products. And it is these products that are providing the safety net for Marvell as it continues to invest heavily in R&D for the expansion into the new products. Once these new products come online, Marvell could go back to the high net margin levels and enjoy higher levels of profitability. Now the earnings per share for this quarter is a small 3 cents. Nothing much to shout out about, but the important thing is the transition from a negative to the positive. Marvell has good positive cash flow from operations, indicating they have a good business and good products. There was a big cash outflow in investing activities in 2018 due to the Cavium acquisition. This cash outflow of $2.6 billion was due to the acquisition. Marvell took on debt of $1.8 billion for the Cavium acquisition as reflected in the cash inflow for financing activities. But Marvell has not gone too deep into debt to finance their operations as they still enjoy positive cash flow from operations. Marvell's cash position is healthy. There is not much change for the past 3 years. The quick ratio is below 1 at 0.69. But they are well financed to meet any short-term financial obligations, so no concerns over here. Overall, Marvell's balance sheet has remained healthy. There was a big jump in total assets with the Cavium acquisition. These are mainly for goodwill and intangible assets. As a technology company, they have thousands of patents, but it is a bit tricky to measure the real value of these goodwill items. The book value per share is at $12.60 currently. The book value measures the net asset value, which is total assets minus the total liabilities on a per share basis. At the current price of $49.66, Marvell is trading at a multiple of 3.9 times price to book. The market has valued it lower compared to the other stocks in this space as it has been running losses for the last 2 years while the rest are making tons of money. As I mentioned earlier, Marvell could potentially be a good turnaround play. The trick is to get in after a clear indication that it has turned profitable and before the general market realizes that. Stock-based compensation has doubled even as the company continues to run losses. The stock-based compensation includes engineers, staff, and management's compensation. It is debatable whether is it okay for a company to compensate themselves even when running losses. But for a high-tech company, there is also the need to employ the best engineers, and this is one way to entice the top minds. And at $59 million, which is a fraction of their revenue, in my view, it is quite alright. The PE to growth ratio is not relevant as Marvell has been running losses. The PEG ratio measures price to earnings in terms of revenue growth. A PEG ratio of 1 indicates that the price is increasing at the same rate as the revenue growth, and a ratio above 1 is when the price has gone up too fast and is not supported by fundamental revenue growth. Investors look for a positive PEG ratio below 1. Marvell stock price has gone up from $18 in Q1 of 2019 to $49 currently. At the same time, while the revenue has been growing, the rate of growth is in the low 3 to 6 in the most recent quarters. The price has run up too fast ahead of the actual revenue growth. I think the market got bought into the KVM story. Based on this alone, there is a higher chance for the price to correct than to appreciate any further. Let's take a look at the technical analysis. Marvell's price has accelerated sharply since the big drop in March of 2020. The entire rise can be encapsulated in the blue trend channel. This channel was broken quite convincingly with a long candle bars and high volume. Let's take a look at the technical analysis. Marvell's price has accelerated sharply since the big drop of March 2020. The entire rise can be encapsulated in the blue trend channel. This channel was broken quite convincingly with very long candle bars and a high volume. But the price bounced just as quickly and appears to be doing a back test of the trend channel. There are two overhead resistance levels at 48 and 50. It has recaptured the 48 level and is retesting the $50 level. If it can go above $50, then I think higher levels are possible. But if it is not able to break above 50, then a bigger correction is more likely to happen. In summary, my view is Marvell could turn out to be a turnaround play, but the share price has risen too sharply in recent times. The market is anticipating the turnaround and the price has already reflected the potential gain. Looking at the way the price has moved, there is a lot of hope baked into the price. Hope-based investing is very dangerous. If it does not come to fruition, the price could collapse. There are other much better stocks to invest in at this moment. I just made another video on the best 5G stocks to invest in. Do check out that video too. Subscribe to my channel if you have found this sharing useful and hit the notification bell so that you don't miss out on any of my future videos. And I'll see you soon in the next one.